Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And then this video will be going over A-Level Accounting 2023 October-November paper 1-1. This is a multiple choice paper which consists of 30 questions. Each of them will be of 1 mark. And the total time limit given for this paper is 1 hour, which means that in this video as well, we'll be attempting to solve this paper under 1 hour. So without any further delay, let's get started. For the first question, which sources are external short-term sources of finance for a limited company? The very first one we have is bank overdraft. Remember that the short-term means that this has to be of current nature, which means that this should be repayable within the next year. So it should not be more than 1 year period. Then we're talking about external source of finance. So it should not be internally generated sources such as the retained earnings. So it should be some sort of finance that will be provided by parties that are not directly related to the business. Okay, so the first one we have is bank overdraft, and remember bank overdraft is something that will be acquired from a bank, and that's the other party, right? So it's not directly generated by the business itself, which qualifies this as the external source of finance. And for the short term, it needs to be repaid within the next year. And bank overdraft is something which we classify as current liability, which will have to be repaid in the next year, which also classifies this as the short-term source of finance. So this one is correct. The second one we have is retained earnings. So remember that retained earnings will not qualify as our external source of finance because this is something that will be generated by the company internally. So second one is incorrect. The third one is share capital. Okay. Now share capital is something that will be generated by the external party. But again, we're talking about shareholders, so that's the main source of finance for the company itself. But this is not the short-term source of finance. This is a long-term source of finance because we're talking about capital. This will not be repeated within the next year. So this again is incorrect. And the fourth one we have is trade credit. So trade credit is something that will be provided by our suppliers, right? That qualifies this to be external source of finance. And regarding short term, again, remember trade credit, you can understand this as trade payables because they are basically allowing us a longer period for us to pay back the money to the supplier, which means that the business will have the amount for a longer period of time. So that definitely qualifies as the external sources of finance. And regarding short term, since this is related to trade payables, which will be classified as current liabilities, it means that it will have to be repaid within the next year. So this also is a short-term source of finance. So the correct answer that we're looking for is 1 and 4, which is given in option B. Okay. Now for the second question, a sole trader settles an account payable in full with her own money. Okay, so her own money, meaning that this is not the business's money, right? This is her own personal wealth. And this transaction has not been recorded. Now what will be the effect when this is recorded? Always remember that there will be twofold effect of each transaction on our accounting equation. So the accounting equation is asset equals to capital plus liability. So from each transaction, two of these three items will be affected and the equation will be balanced at all times. So if we're looking at asset increment, then it means that either the capital or the liability should increase, right? And in this case, we're talking about settlement of an account payable, right? So if we're settling account payable, it just means that we are now reducing our liability. So the liability is being reduced or decreased, and this is being done by her own money. Now, in order for this equation to be balanced, either the asset should increase or the capital should increase by the same amount, right? But in this case, we're talking about her own money. This is not any resource that has been utilized which already existed within the business. This is the new money that the sole trader introduced to the business, which means that additional capital has been introduced in the business. So capital will increase. So the correct answer we're looking for is increment in our capital and the decrement in liability. The first one is asset decrease. There is no asset involved within this transaction, so A is incorrect. B again is incorrect due to the very same reason. For the third one, we have liability decreased, which is correct, and we have capital increased, which is again correct. So that's the answer we're looking for. And for the fourth one, we have liability increased, which is incorrect. That's why this one is incorrect as well. Now for the third question, Sally had 1,000 in the bank when she paid 1,500 to buy goods for resale. The bank allowed the payment. Okay, so even though she only had 1,000 in the bank account, the bank allowed the payment of 1,500, which means that the bank gave Sally 500 as bank overdraft. Okay. Now, how is this transaction recorded in Sally's books of accounts? Okay, so the first thing that Sally did was bought goods worth 1500 for resale, right? So we're talking about purchase in this case, and purchase is always recorded on the debit side. So the purchase was made of 1500, and this purchase was funded by the bank account for Sally's business, right? So bank will have 1500. That's the transaction we're looking for. And don't get confused by this 500 bank overdraft. We do not record the bank overdraft separately within a transaction, because that amount of 500 also came out of Sally's account itself, right? So we're essentially talking about the bank account for this 500 as well as the 1000 that already existed in her business's bank account. So both of these amounts, so 1000 plus 500, will be recorded under the heading of bank itself. So there will be no separate amount under the heading of bank overdraft. Don't get confused with that. So we're looking for this transaction. So account debited should have purchases. So that's for C and D. And on our credit side, we need only bank, not the bank overdraft. So this gives our correct answer to be option C. Now for the fourth one, which items identify revenue expenditure and a capital receipt? So revenue expenditure, so for expenditure, we're looking at recurring expenditure. And capital receipt, so we're looking at non-recurring income. Okay, so for option A, we have carriage inward on a non-current asset. And remember, this is not your carriage inward on goods purchased for resale, because that's the frequent event, right? You have to keep purchasing goods for resale for your business. But we're talking about non-current asset in this case, and the purchase of non-current asset is not a frequent event for a business. So this will classify as non-recurring expenditure, which means that this cannot be classified as revenue expenditure. This is a capital expenditure. So option A is incorrect. Now for option B, we first have commission received, and this is not commission paid. We're talking about expenditure here, but we have commission received, which will classify this as revenue income. Again, this is incorrect. And for the third one, we have discounts allowed. Okay, so discounts allowed is an expense, and this will be allowed frequently because discount will be allowed whenever the goods will be purchased by our customers, right? So you can classify this as recurring expenditure. This is correct. Now for capital receipt, we have cash drawings. And cash drawings is when the business will have lesser amount because the owner will withdraw cash of the business for her personal expenses. So that's definitely not an income for our business, right? So this cannot be classified as capital receipt, which means that option C is incorrect. So by default, option D will be correct. Let's take a look at these statements given. For our revenue expenditure, we have a repair of motor vehicle. So repairs have to be made frequently, right? Repairs and maintenance are a recurring expenditure. So this is correct. Then for our capital receipt, we have receipt of loan from lender. And loan will always be classified as non-current liabilities. This is something that will have to be repaid after 1 year, not within the next period, right? Due to this reason, this can be classified as capital receipt. And also remember that loan is not taken time and again by the business. That will be taken in times when the business has been facing some sort of liquidity crisis, right? So that's not a recurring event. That can be classified as a non-recurring event, which is why it justifies this receipt of loan from lender being a capital receipt. That's all for the fourth question. Now for the fifth one, which statement identifies why depreciation is provided on non-current assets? Okay, so always remember that depreciation essentially divides the cost of the non-current asset among the years in which that particular non-current asset will be used, right? And the main concept is that any uses that you get from your non-current asset, you have to allocate the expenses in the consequent years, right? So that's the concept that we're looking for. Option A, so that the cost is allocated to periods that benefit from them. So this is the exact same thing that we're looking for, because any benefit that is derived by the use of that particular non-current asset should have the same cost, because matching concept will be applied that way, right? So option A is the correct answer. Let's have a look at the remaining options as well. So that the realization concept is applied. So realization concept is mostly used in cases of incomes or profits, but in this case, we're talking about depreciation on non-current assets, right? So realization will be in the sense that when our non-current asset is purchased, the entire expenses or the entire cost is not shown as expense. So we cannot really say that option B is correct. Now for the third option, so that there is enough cash in the business to replace them. Again, depreciation is not accounted for so that the company can accumulate cash, because depreciation is a non-cash expense. We're not expending any cash. So we cannot say that there is any accumulation of cash in the business in order to replace the non-current asset. So that's incorrect. And for the last one, so that they are shown at market value. Remember, when depreciation is provided, the non-current assets will be shown at its carrying value, not the market value. So this is again incorrect. Now, for the sixth question, new equipment costing 40,000 with an estimated residual value of 6,000 was acquired at the beginning of the year on 1st January. On the same date, the business made the following payments in respect of the equipment. So we have delivery payment. Remember, this is our capital expenditure because delivery of the non-current asset will have to be done once. It's not a recurring event. Then we have the installation. Again, that's the same thing. This is our capital expenditure. And remember, the capital expenditure will be included as part of the cost of the non-current asset. So our delivery cost as well as the installation cost should be included as part of the cost of the new equipment. Then we have the 8-year maintenance contract. And remember, maintenance is something that will have to be done time and again. So this is the revenue expenditure for 8 years. So this will not be included as part of our cost. Now, the equipment has an estimated life of 8 years. The business uses the straight line method of depreciation. What would be the carrying amount? So that's the net book value for this item at the end of the year on 31st December. Okay, so we just have to figure out the depreciation charge for the current year, subtract it from our cost and get the carrying amount. The first thing that we need to do is figure out the correct cost for our new equipment. We start with a given cost of 40,000. Then we also include all of our capital expenditure, such as the delivery of 5,000 and the installation of 7,000. Now this will give the total cost of the new equipment to be of 52,000. Now let's calculate the depreciation charge. And in this case, we need to use the straight line method, and we have been given the estimated life as well as the residual value. So the formula will just be cost minus residual value divided by useful life. So the cost, we've already calculated it to be 52,000. Then the residual value is given as 6,000. And the useful life is of 8 years right here. Now this gives the depreciation charge for the year to be 5,750. Now let's calculate the carrying amount. So remember, carrying amount is just the cost minus accumulated depreciation. And this is the first year for this new equipment, which means that the accumulated depreciation is just going to be the depreciation charge for the year. We have the cost of 52,000. The accumulated depreciation is of 5,750. Now this gives the carrying amount to be 46,250. So this is the answer we're looking for, and it is given in option B. Okay. Now, which error would not be identified by preparing a trial balance? The first one is a contra entry of 650 had been entered twice in the sales ledger control account. Okay, so if the contra entry had been entered twice in the sales ledger control account, it means that our trade receivables value will be incorrect. And while creating a trial balance, it just means that the value on the debit side will not be equal to that on the credit side. So this error will be easily identifiable since the debit amount and the credit amount will not be equal. So this is not the answer we're looking for. For option B, a purchase invoice of 495 had been recorded as 459 in the purchases journal. So we're talking about journal in this case, which is the book of prime entry. So this is the error that was made as part of the original entry, and errors of original entry will not be disclosed or identified by preparing a trial balance, which means that option B is the correct one. Now let's take a look at the remaining options as well. For the third option, carriage inwards of 57 in the cash book, which is again the book of prime entry, had been recorded as 75 in the carriage inwards account. So it had been recorded correctly within our original entry, but there was an error while making the entry within our carriage inwards account, which means that this is an error of transposition, which will again be easily identified by preparing a trial balance. So this is not the answer we're looking for. And for option D, discount allowed of 35 had been credited to the discount received account. So this just means that our discount allowed will be understated and the discount received will be overstated within our trial balance, right? Which means that again, the debit total and the credit total will not be equal. So this will again be identified by preparing a trial balance. So this is incorrect. Now for the eighth question, during the year, a sole trader withdrew 3,000 cash from the business bank account. Accounting entries made were a debit of 300 to the drawings account and a credit of 3000 to the bank account. And remember, the error here is that 3000 was the cash drawings, but only 300 was recorded within our drawings account. In addition, 500 had been omitted from the discount received account in the trial balance. Now we need to figure out what was the balance on the suspense account before these errors were corrected. So whenever you are doing any question for suspense account, I suggest that you first rectify the errors within your trial balance, and it makes it way easier for you to create your suspense account. Okay, so this one is the trial balance, this one is the suspense account, and we're trying to figure out the opening balance for our suspense account. And remember, the entries on our suspense account will be the opposite one that we make within the trial balance by rectifying these errors. Okay, so the first rectification that we need to do is the drawings account, because drawings account is understated. It should have been 3000, but we've only recorded 300, right? So the understatement in this case is of 3000 minus 300, which is 2700. So we now need to enter 2700 as our drawings within the trial balance, right? And drawings will always be recorded on the debit side, so we need to enter 2700 on the debit side within our trial balance. Now, the entry for this rectification within our suspense account will be done on the opposite side, which means that there will be 2700 on the credit side. Okay, also let us leave the space for our opening balance. Okay, now for our second error, 500 had been omitted from the discount received account in the trial balance. So again, it's the same case. Discounts received is understated by 500, and discounts received is our income. So all of our incomes will be recorded on the credit side within our trial balance. So we just have to enter 500 on the credit side. Now, the similar entry within our suspense account will be made on the debit side. Okay, so those are all of our errors. Now we can see clearly that our credit side is the heavier side. So the total on both sides will be of 2700, and the balancing figure on this side will be our opening balance. So that will be 2700 minus 500, which is 2200. So the correct answer we're looking for is 2200 on the debit side, and that is given in option A. That's the answer for question number 8. Now, a company's bank statement showed a credit balance of 2000. Credit balance means that this is a positive amount. Then the following issues were found. A receipt of 2700 and a payment for 3000 were recorded on the bank statement, okay, and both had been omitted from the cash book. Okay, so these are the entries that have been missing in our cash book. And then the bank charges of 500 were correctly shown on the bank statement but had been recorded as 600 in the cash book. Again, this is the error that will have to be adjusted within our cash book. Now, what was the cash book balance before any necessary adjustments were made? And remember, we first prepare our bank reconciliation accounts starting with the balance as per our bank statement, and we have to account for uncredited checks and outstanding deposits in order to get our balance as per the cash book, right? And that's the balance as per the cash book after making these adjustments. And in this case, we have not been given any information regarding our uncredited checks and outstanding deposits. So we can just assume that the balance as per our bank statement will be equal to the balance as per our cash book, and this will be the balance after making these adjustments. Okay, so we just have to prepare the cash book for this one. And remember, cash book, we are basically making entry for our cash, right? And cash is an asset, which means that any positive amount that we have will be on the debit side. Any negative amount that we have will be on the credit side. Also, any incomes will be recorded on the debit side. Any expenses will be recorded on the credit side. And in this case, we have a positive bank balance, right? So the closing balance of 2000 will be on the credit side. Okay. Now, let us look at the first error again. A receipt of 2700 and a payment of 3000 were recorded on the bank statement. Both had been omitted from the cash book. So 2700 is a receipt that will go on our income side. And then 3000 was the payment that will go on our expenses side. Then the bank charges of 500 were correctly shown on the bank statement but had been recorded as 600 in the cash book. So basically our expenses has been overstated, and whenever there's any overstatement, we just have to subtract it by the same amount by entering the difference on the opposite side. So in this case, the difference is just 600 minus 500, which is 100. So 100 is excess on our credit side, which means that in order to remove it, we can just enter the 100 on the debit side. Okay, in this case, we can clearly see that the credit side is heavier. So let's figure out the total from that side. That's 3,000 plus 2,000, which is 5,000. Now we need to enter a balancing figure on the debit side, and that will just act as our opening cash book balance. So that's the cash book balance before any necessary adjustments were made. Now that will be 5,000 minus 2,700 minus 100, which results in 2,200. So we're looking for 2,200 in our answer, and that is given in option C. Now for question number 10, why might a business maintain a sales ledger control account as part of the double entry accounting system? The first one is to facilitate prompt preparation of financial statements. So this one is correct because sales ledger control account will give us the correct balance for our trade receivables. So this will definitely help in preparation of financial statements. The second one is to help reduce fraud. That is also correct because sales ledger and sales ledger control account will be prepared by two different staffs, which means that the trade receivables balance as per the sales ledger and the trade receivables balance as per the sales ledger control account should be the same in order to conclude that there has been no fraud. So the second statement is also correct. Now for the third one, to provide details of all the sales transactions. So remember, the sales ledger control account will only record the credit sales, not our cash sales, which means that the third statement is incorrect. So we're looking for 1 and 2, which is given by option A. Now for question number 11, the purchases ledger control account showed a balance of 79,500 before the following errors were taken into account. And we need to figure out the trade payables, which should be included in the statement of financial position. So let us just prepare the purchases ledger control account. Okay. And we're starting with the amount of 79,500. Remember that this is the amount for our trade payables, which is our liability. So the opening balance will go on the credit side. So that's 79,500 right here. Now we need to rectify the given errors. The first one is a contra of 5,300 between the purchases and sales ledger control accounts had been omitted. And remember, contra will always be recorded on the debit side in case of our purchases ledger control account. So that's 5,300 right here. Then the cash purchases of 1,200 made on the last day of the period had not been recorded. And this talks about cash purchases, not the credit purchases. And remember, within our purchases ledger control account, we only record credit purchases. So we do not have to record this 1,200. Then the discounts received column in the cash book had been overcast by 6,200. And this is the error in the cash book, right, which is the book of prime entry. And the basis for our purchases ledger control account is the book of prime entry. So if there has been an error in the cash book, that error will also be reflected within the purchase ledger control account. So we need to rectify this error here as well. And we're talking about the discount received column being overcast by 6,200. Remember that we normally enter the discount received on the debit side within our purchases ledger control account. And since this is an overcast, in order to rectify this error, we just have to enter the overcast amount on the opposite side. And discount received normally would be on the debit side, which is why this overcast of 6,200 will go on the credit side. Then we have the returns inwards journal. So returns inwards is the sales returns. And we're talking about purchases ledger control account in this case. So this information regarding the return inwards journal is irrelevant. So we don't have to include this one. Now, clearly, our credit side is the heavier side. So that's 79,500 plus 6,200, which results in 85,700. Now, the new balance for our purchases ledger control account is 85,700 minus 5,300, which results in 80,400. So this is the correct trade payables figure. And that's given in option C. Now for question number 12, a business has trade receivables of 52,000 at the year end. The allowance for irrecoverable debts in the draft statement of financial position is 3,000, and the allowance for irrecoverable debts is to be changed to 5% of trade receivables. What is the effect of changing the allowance on profit as well as on current assets? So let us first figure out the new allowance for irrecoverable debts. That is just going to be 5% of 52,000. So 52,000 times 5%. This results in the amount of 2,600. Now we can see that the previous allowance for irrecoverable debts is higher than the new allowance for irrecoverable debts. And since the new allowance for irrecoverable debts is lower, it means that this will result in an increase in the profit. And the increase in profit will be by the difference. So that's 3,000 minus 2,600. That results in the amount of 400. And this is an increase because normally the allowance for irrecoverable debts will be considered to be an overhead. And since now our overhead has decreased, the profit will automatically increase. So we're looking for increase by 400 on our profit. So that's given in option C and D. And on our current assets, remember that the current assets is shown as trade receivables minus the allowance for irrecoverable debt, right? In this case, the allowance for irrecoverable debt has decreased, which means that this overall figure will increase because the negative amount is decreasing, right? So the total current assets will increase again by the same amount. That's the difference. So we're looking for the impact on current assets to be increased by 400, and that is given by option D. So the correct answer is D. Now for question number 13, a trader prepared her financial statements but made no adjustments for accrued rent receivable at the end of the year. Now what is the effect of this omission? We need to figure out the effect on current assets, current liabilities, as well as profit for the year. Okay, let us first start with profit for the year. Since we're talking about accruals at the year end, this should be added, right? And we're talking about rent receivable. So this is an income, right? So the income that should have been added is missing, which means that the profit is understated, right? Because we have missed this additional income. So we're looking at understated for profit for the year, which is given in option B and D. Then the accrued rent receivable itself, we're talking about income, right? And income receivable. So we've already provided the services for it, but we are yet to receive the income. So the receivables is automatically our current assets, right? And we have not recorded this within our financial statements, and that includes the statement of financial position as well. So the current assets will also be understated, which is given in option C and D. And as for our current liabilities, there will be no effect because we're talking about accrued rent receivable, which is not a part of our current liabilities. So we're looking for no effect in this case, which is given in option B and D. So the correct answer for all three current assets, current liabilities, and profit for the year is given by option D. Now for question number 14, a sole trader calculated her draft profit for the year as 50,000. She asked her accountant for advice regarding 4 issues which she thought might affect the draft profit. We need to calculate the profit for the year by considering these 4 issues. So let's start with the given draft profit of 50,000 right here. Now, the first issue is that a customer debt of 2,000 needs to be written off as irrecoverable. So irrecoverable debt will always be treated as overhead, which means that it will be subtracted while calculating profit for the year. So we just have to subtract 2,000. Then she accounted for her drawings of 10,000 as if they were staff salaries. Remember that drawings will be adjusted within the capital account in the statement of financial position, not within the statement of profit or loss, which means that this 10,000 should not have been recorded within the statement of profit or loss, but they were treated as staff salaries. And by treating it as staff salaries, it just means that the 10,000 was subtracted while calculating our draft profit, but that's incorrect. So now we have to reverse this entry, and the reversal of a negative is just adding the same amount. So we just have to add 10,000. Then she wants to increase the value of non-current asset by 20,000. So the increment of the non-current asset will be shown as revaluation upwards. That will be recorded within our equity. So revaluation reserve will be increased by 20,000. Then the non-current asset will be increased by 20,000. Both of these will be recorded within our statement of financial position, not in the statement of profit or loss. So this third information will have no impact within our profit for the year. Then the existing charge for the depreciation is overstated by 5,000. So we now have to subtract the depreciation by 5,000. We have to reduce it by 5,000, right? But remember, overall, the depreciation is again subtracted as part of the overhead while calculating the profit for the year. So the total impact of this rectification of the fourth statement is that we just need to add the 5,000 back. So that's plus 5,000. This gives the correct profit for the year to be 63,000. That's the answer we're looking for, which is given in option C. Now for the 15th question, which items in the books of a partnership would increase the profit available for distribution to the partners? Okay, the first one is discount received. So discount received would definitely be considered as part of our income, and income will always increase the profit available for distribution, right? So this is correct. The second one is interest on capital. So remember, interest on capital is something that will be paid by the partnership to the partners out of the profit for the year. So interest on capital will be subtracted while calculating the profit available for distribution or the residual profit. So this is incorrect. Then we have interest on drawings. Now interest on drawings is opposite because this is something that the partnership will receive from the partners. So this will be added to the profit for the year while calculating our residual profit. So this is what we're looking for. And the fourth one is partnership salary. Again, this will be deducted while calculating the residual profit. So this is incorrect. The correct answer we're looking for is 1 and 3, which is given in option B. Now for the 16th question, L and M are in partnership, sharing profits and losses in proportion to their capital invested. The following information is available. So we have been given the capital balances for L and M. We have the profit for the year before appropriation. We have the drawings. Then no interest is charged on drawings up to 10,000 for each partner. Interest at a rate of 5% is charged on any drawings in excess of 10,000. Okay, so let us calculate the interest on drawings. For L, we can see that the drawings is 8,000, which is less than 10,000, right? And no interest will be charged on drawings up to 10,000. So no interest on drawings will be there for partner L. But for partner M, we can see that the drawings is of 12,000, which is greater than 10,000. So the excess of 10,000 is just going to be 2,000 in this case, right? So for M, that will be 12,000 minus 10,000. This is a calculation of excess amount beyond 10,000. Then we need to charge a rate of 5% to this value. So that's times 5%. So this gives the interest on drawings for partner M to be of 100. Okay. Now we first need to calculate the residual profit. So for this one, we start with the profit for the year before appropriation. That's 28,900. And then we have to make an adjustment for the interest on drawings for partner M. And interest on drawings is something that the partners will pay to the partnership. So the profit will increase. So we just have to add the interest on drawings. This will give our residual profit to have the value of 29,000. Now we only need L's share of residual profit, right? And we were told that the profits and losses will be shared in the proportion to their capital invested. So capital invested is given right here. Let us first figure out the total. So that's 68,000 plus 102,000, which results in 170,000. So L's share, we just start with the given or the calculated residual profit. That's 29,000. Then we multiply by L's capital ratio. So that will be 68,000 out of the total of 170,000. So 68,000 divided by 170,000. This gives the value of 11,600. This is the answer we're looking for, and it's given in option B. Now for the 17th question, which statements describe the advantages of a rights issue of shares? The first one is additional funds for a company can be raised cheaply. Additional funds is true because while making a rights issue, external shareholders or the existing shareholders will provide finance or new money into the business. So the first statement is correct. For the second one, control of the company remains with existing shareholders if all rights are taken up. This is again true because the rights shares will only be offered to the existing shareholders. So no new investors can enter a business by purchasing the rights issue of shares. So statement 2 is also correct. For the third one, it is an alternative to dividends as a way of rewarding existing shareholders. This is not correct. This would have been correct, but only for the bonus issue of shares, because bonus issue is funded by the reserves of the company itself. The shareholders will not have to pay any finance for this one. But this is incorrect in case of our rights issue of shares. So the answer we're looking for is 1 and 2, which is given in option A. Now for the 18th question, the following information is available for a limited company's financial year ended 31st December. We have to figure out what was the total equity on 31st December. Okay. At 1st January, the total equity was 350,000. Let's start there. And this included 100,000 ordinary shares of 1 each. Okay. So we have a total of 100,000 ordinary shares, and since the nominal rate is 1, the value of share capital will also be 100,000. On 30 June, there was a rights issue of 10,000 ordinary shares for 1.50 each. This was fully subscribed. So the rights issue will bring in additional capital into the business, right? So that will be 10,000, the number of rights issue, multiplied by the rate at which it was issued. So that's 1.5. This gives the total capital raised to be of 15,000. So this will definitely be added to equity. So let's add it. Then on 1st October, the company paid a dividend of 0.10 per ordinary share. Remember that we had 100,000 ordinary share at the beginning of the year. Then we introduced 10,000 new shares. So the total number of ordinary shares we have at the time of dividend payment will be 110,000. So the total dividend paid will be the number of shares, that's 110,000, multiplied by the rate of dividend, which is 0.10. This gives the total dividend to be 11,000. And dividend will be subtracted from our retained earnings, which means that it will also be subtracted from our total equity. Then on 1st December, a dividend was proposed totaling 20,000. Proposed dividend will have no impact within our equity, so we can just completely ignore this. Then the profit for the year was 26,500. And profit for the year will always be added to our retained earnings, which is a part of the equity, which means that this should be added here as well. Now this gives a total equity on 31st December to be of 380,500. This is the correct answer we're looking for, which is given in option C. Now for the 19th question, why would employees be interested in their employer's financial statements? So they will be interested in order to assess their job security, to see whether or not the business will continue in their operations so that they can be employed in that particular business in the future as well, right? That's the main concern. And the other concerns will be whether or not the business is earning enough so that the employee might have a chance at promotion or have a chance at any sort of bonus. Okay, so the first option is to assess whether the business can continue to trade in the foreseeable future. So this again directly ties up to the fact that they will be interested in their job security, and their job will only be secure if the business has enough trading capability in the future as well. So option A will be the correct answer. Let's take a look at the remaining options as well to compare their salaries with the employees of competitors. This is incorrect because their salaries will not be disclosed as part of the financial statements. Then the third one is to put a value on the reputation of the business. So reputation of the business will be subjective and it has nothing to do with the financial values shown within our financial statements. So this is again incorrect. Then the fourth one is to understand the impact of the business on the economy. Again, the financial statements will only show the values of the company itself. It will not show the value comparing it to the entire economy. So that's incorrect as well. Now for the 20th question, a business received a 5-year loan of 40,000. The loan was paid into the bank current account. Now we need to figure out the effect of the loan on our current ratio. Okay, so on the current ratio, since the 40,000 was now paid into the bank current account, it means that the bank balance for our business has increased. So this means that our current assets has increased. And remember, the current ratio is just current assets divided by current liabilities. So if the current assets has increased, the total current ratio will also increase. So we're looking for increased given in C and D. Then we have our return on capital employed. So remember, the formula for return on capital employed is profit from operations divided by capital employed. So capital employed will include the equity as well as non-current liabilities, right? In this case, we're talking about a 5-year loan, which is a non-current liability. So our non-current liability is being increased, which means that our capital employed will increase. So the total return on capital employed will decrease because the denominator term is increasing in this case. So we're looking for decrease, which is given in A and C. So the correct one for both current ratio and the return on capital employed is given in option C. That will be our correct answer. Now for the 21st question, the draft financial statements of a business for the year ended 30 June included the following. So we have the revenue and the gross profit. It was subsequently discovered that the closing inventory was understated by 10,000. Now we need to calculate the gross profit margin after correcting this error. Okay, remember that in this case, we're talking about understatement of closing inventory. So we basically have to now add back 10,000 to the closing inventory, and the closing inventory will be subtracted as part of our cost of sales, right? And the total cost of sales will then be subtracted in order to calculate the gross profit. So we have to add 10,000 as part of our closing inventory, but the closing inventory will be subtracted and the cost of sales will also be subtracted, right? So a positive, negative, and a negative will result in a positive. This just means that we now have to add back this understated amount of 10,000 to the gross profit in order to get the corrected gross profit. So that's plus 10,000. This results in the correct gross profit to be of 70,000. Now, the correct gross profit margin will be the gross profit of 70,000 divided by the revenue of 280,000 multiplied by 100%. This results in the gross profit margin to be 25%. This is given in option D. That's the correct answer. Now for the 22nd question, the following information is available for a company. We have the sales revenue for the year, debenture interest paid, gross profit margin, operating expenses to revenue ratio, and the return on capital employed. Okay, we need to figure out the company's capital employed. Okay, so we have to work with our return on capital employed. That's 16%. And the return on capital employed is just the profit from operations divided by our capital employed multiplied by 100%. In this case, we're trying to figure out the capital employed. So we first need to calculate our profit from operations. Now we have the gross profit margin as well as the sales revenue. So we can easily calculate the gross profit in this case. That will be the sales revenue of 1,600,000 multiplied by the gross profit margin of 20%. This results in the value of 320,000. Then we also have the operating expenses to revenue ratio, which is given as 12%. And the formula is just our overheads divided by our revenue of 1,600,000 times 100% will be equal to 12%. So our overhead is just going to be 12% divided by 100% multiplied by 1,600,000. This results in 192,000. And since we now have the gross profit as well as all of our overheads, we can easily figure out the profit from operations. That will just be gross profit of 320,000 minus the overheads of 192,000. This results in the profit from operations to be of 128,000. Now let's input this value into the formula for our return on capital employed. So let's bring the 100 to the other side. That will be 16 by 100 equals to 128,000 divided by the capital employed. Now we'll cross multiply. This will give our capital employed to be of 128,000 times 100 divided by 16. This results in the value of 800,000. So that's the answer we're looking for, which is given in option C. Now for the 23rd question, what are the benefits of operating a just-in-time system of inventory management? The first one is increased efficiency, which is correct because just-in-time system of inventory management means that we will only purchase the required materials at the time of need. So we won't be stocking it ahead of the time, right? So it won't have any storage cost, it won't have any obsolete inventory, and overall the inventory management process will be a lot more efficient. So the statement 1 is correct. The second one is reduced warehouse cost. Again, like I said before, we do not have to go through any storage cost because we will only be purchasing the inventory at the time of need, right? So this is also correct. Then the third one is reduced waste. Again, this ties up to my point being reduction in obsolete inventories as well, because we only purchase the inventories at the time of need, which means that we do not have to store inventory for a long time to the point where some inventories might be damaged. So that will definitely reduce waste as well. So the correct answer we're looking for will include 1, 2, and 3, which is given by option A. Now for the 24th question, 8 employees work in a team. Each employee is paid 16 an hour and the team share a group bonus between them, which is based on their output of product. For any production in excess of 500 units, the team as a group is paid a bonus of 8 per unit, and the bonus is shared equally and paid on a weekly basis. Last week, each member of the team worked 40 hours and the team as a whole produced 560 units. What is the pay of each member of the team? Let us first figure out the pay of the team itself. So each member of the team worked 40 hours, and we're talking about 8 members, right? So that's the total hours worked. And we also know that each employee will be paid 16 an hour. So we just need to multiply it by 16 in order to get the hourly rate paid to the 8 employees who work in a team. Now we need to calculate the bonus as well. So we can see that the total units produced was 560, and the bonus will be paid as 8 per unit in excess of 500 units. So the excess of 500 units in this case is 60 units. So plus for these 60 units, 8 will be paid per unit. So the total pay for the team within that particular week will be 5,600. Now we need to figure out the pay of each member. And since the bonus will be split equally among the team, we just have to divide this 5,600 by the total number of employees within that particular team. And that's 8, right? So we're looking at 5,600 divided by 8, which will give the value of 700. So that's the answer we're looking for, which is given in option A. Now for the 25th question, which type of business is most likely to use a batch costing system? So batch costing system will be used by those businesses who will manufacture goods in bulk as well as the same type of goods. So there will be no modifications from one item to another item, right? All of the item will go through the same process repeatedly. The first one is an aircraft manufacturer. So remember that aircraft cannot be manufactured in a batch because each aircraft is unique. It will require some unique working. So option A is definitely incorrect. The second one is a car component manufacturer. Okay, so the component will be the same, right? And no one is going to produce a component independently. That might be the case for a car itself, but we're talking about a car component. And the component will go through a batch production or a mass production. So option B is the correct answer we're looking for. Let's take a look at the remaining options as well. The third one is a ship construction yard. Again, ship is similar to an aircraft. Each of them will have some unique designs and unique work will be made. So it cannot be mass produced. That's incorrect. And the fourth one is a wedding cake maker. So wedding cake maker, the designs will be given to them weeks ahead of time, right? They have to work on each unique design according to what the couple wants, right? So again, there can be no mass production or batch system for a wedding cake. So that's incorrect as well. Now for the 26th question, a company is asked to make a new machine for a customer. It provides the following estimates. Materials will cost 1100, labor will be 30 hours at a cost of 14 per hour. Then the company charges overheads at 10 per labor hour and has a markup of 30% on total cost. We need to figure out the price on the job cost sheet. We first have to figure out the cost of the job, then add the markup in order to calculate the price. So we can start with the materials of 1100. Then the labor, 30 hours will be worked at 14 per hour. So that will be 30 times 14. Then we have the overhead of 10 per labor hour. So that will be plus 30 hours multiplied by 10. This will give the total cost of the job to be 1,820. Now for the price of the job itself, we just have to apply the markup of 30%. So that will be 1820 times 1 plus 30%. That results in the amount of 2,366. That's the answer we're looking for, which is given in option D. Now for the 27th question, which formula would be used to calculate an overhead absorption rate for a capital intensive production process? So capital intensive just means that we heavily rely on machine itself. So we're looking at higher machine hours as compared to the labor hours. So the overhead absorption rate will just be calculated as our total overhead divided by machine hours. This is the answer we're looking for. And in this case, that's given in option D. Now for the 28th question, a company provides the following information. We have two different departments, X and Y. We have been given the budgeted overheads, budgeted direct labor hours, as well as the budgeted machine hours. We need to figure out what is the most appropriate overhead absorption rate for each department. Okay, so we just need to calculate the overhead absorption rate for X as well as Y. We first start with the budgeted overheads. For X, it's 150,000. Then we divide it by the higher of the budgeted direct labor hours and budgeted machine hours. In this case, we can see that the machine hours is higher, so that will be 8,000. So the overhead absorption rate for department X is going to be 18.75 per machine hours. Now for department Y, we have the overhead to be 210,000. And in this case, we can see that our direct labor hours is greater. So that will be used as our denominator. And this will give the overhead absorption rate for department Y to be 21 per direct labor hour. So we're looking for these two within our answer. So 18.75 per machine hour is given in A and C, and 21 per direct labor hour is given in A and D. So the correct one for both department X and department Y is given by option A. For the 29th question, a company makes and sells a single type of product. The following budgeted information is available. So we have the selling price per unit, sales volume, variable costs, as well as the fixed cost. And the sales director has recommended a 20% reduction in the selling price of the product. So the selling price should now be reduced by 20%. So that's 10 times 1 minus 20%, which results in 8. That's the new selling price. Then the variable cost will reduce to 4 per unit. So the new variable cost is 4. And the sales volume would be expected to increase by 5%. So the sales volume of 10,000 should now be increased by 5%. So that's 10,000 times 1 plus 5%, which results in 10,500 units. Now, what will be the new budgeted profit? So profit is just going to be the selling price minus our variable cost, and that gives the contribution. And the contribution in this case is 8 minus 4, which is 4. Then we need to multiply the contribution to the total number of units so that we get the total contribution. And then we need to subtract the fixed cost from it to get the profit. So that will be 4 times 10,500 minus 25,000. This results in the value of 17,000. And that's the answer we're looking for, which is given in option B. Now for the 30th question, how is contribution calculated? So the contribution is basically the sales minus all of our variable costs. So this is the answer we're looking for. And in this case, we have absorption cost. So again, remember that the categorization of our cost as variable and fixed is done under marginal costing, right? So the variable cost can also be considered to be our marginal cost. So we're looking at sales minus marginal cost, which is given in option C. Alright, that's all for this paper. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.